Question 1. In a proportional reinsurance agreement, the reinsurer receives a fixed percentage of the premiums paid by the ceding company. The ceding company retains a percentage of the premiums as well, and in return, the reinsurer agrees to assume a similar percentage of the risk. Which of the following best describes this arrangement? A. The reinsurer assumes all the risk and retains all the premiums. B. The ceding company retains 100% of the premiums and risk. C. The reinsurer assumes a fixed percentage of the risk and receives the same percentage of premiums. D. The reinsurer only assumes risk for catastrophic losses and receives a proportionate premium. Answer. C. The reinsurer assumes a fixed percentage of the risk and receives the same percentage of premiums. Explanation. In proportional reinsurance, such as quoted share and surplus share, both the ceding company and the reinsurer share both the premiums and the risk in the same proportions. For example, if the ceding company retains 70% of the premiums, the reinsurer will assume 70% of the risk. This arrangement ensures that the reinsurer exposure aligns directly with the premiums it receives. This structure is typical in proportional reinsurance agreements. Question 2. Mr. Thompson, an insurance underwriter, is tasked with evaluating a treaty reinsurance agreement for a large multi-line insurer. He notices that the agreement has a sliding scale commission, meaning the reinsurer's commission is tied to the profitability of the treaty. What is the primary advantage of including sliding scale commission in such an agreement? A. The commission is fixed, ensuring predictability in payments. B. The reinsurer receives higher commission if the treaty becomes more profitable. C. The reinsurer assumes all the risk associated with the agreement. D. The reinsurer is guaranteed commission regardless of the profitability. Answer. B. The reinsurer receives a higher commission if the treaty becomes more profitable. Explanation. A sliding scale commission is a provision in a reinsurance treaty where the commission paid to the reinsurer changes based on the profitability of the treaty. If the treaty is more profitable, i.e., if fewer claims are made, the reinsurer's commission will increase, aligning their interests with the ceding company. This incentivizes the reinsurer to manage risk more effectively. It's designed to provide both the ceding company and the reinsurer with a share in the success of the treaty. Question 3, scenario-based. Mr. and Mrs. Miller, owners of a large commercial real estate development, recently entered into a facultative reinsurance contract for one of their properties. However, an unexpected fire caused significant damage to the building, and they filed a claim with their primary insurer. The insurer has now requested that Mr. and Mrs. Miller provide documentation supporting their claim to the reinsurer. Which of the following Mr. and Mrs. Miller do in response? A. Provide only the basic loss documentation to the reinsurer, as they are not required to disclose detailed information. B. Disclose all relevant details about the loss, including the cause of the fire, repair estimates, and any other pertinent information. C. Submit the claim only to their primary insurer, as the reinsurer does not need to be involved at this stage. D. Request that the primary insurer deal directly with the reinsurer, involving Mr. and Mrs. Miller in the process. Answer. B. Disclose all relevant details about the loss, including the cause of the fire, repair estimates, and any other pertinent information. Explanation. In facultative reinsurance, the primary insurer must provide full disclosure to the reinsurer about the loss and any supporting documentation. The reinsurer assumes a portion of the risk for that particular event and must assess the claim's legitimacy and the extent of its liability. Reinsurers are entitled to the full details surrounding a claim in order to properly adjust their risk exposure. The ceding insurer, which in this case is the primary insurer, is typically responsible for obtaining this information, but the Millers must cooperate with the process. Full transparency is required for proper claim handling. Question 4. Which of the following is a key characteristic of non-proportional reinsurance, such as excessive loss reinsurance? A. The reinsurer assumes a fixed percentage of the premiums and the risk. B. The reinsurer is only liable for losses that exceed a certain threshold known as the attachment point. C. The reinsurer assumes a fixed percentage of both the premiums and losses, regardless of the amount of risk retained by the ceding company. D. The reinsurer's liability is determined by the overall profitability of the ceding company's portfolio. Answer. B. The reinsurer is only liable for losses that exceed a certain threshold known as the attachment point. Explanation. Non-proportional reinsurance, such as excessive loss, operates by setting a threshold or attachment point above which the reinsurer becomes responsible for covering losses. This type of reinsurance is primarily used to protect the ceding company from large unexpected losses. The reinsurer's liability does not on the overall amount of premiums, but rather on the magnitude of individual claims that exceed the attachment point. This makes it distinct from proportional reinsurance, where the reinsurer assumes a fixed share of both premiums and risk. Question 5. In the context of reinsurance accounting, which of the following best describes the treatment of reinsurance recoverables? A. Reinsurance recoverables are considered part of the ceding company's assets and must be paid back in full regardless of any claims. B. Reinsurance recoverables are liabilities on the ceding company's balance sheet, representing the amounts owed to the reinsurer. C. Reinsurance recoverables represent the amount the ceding company expects to receive from the reinsurer for claims paid under the reinsurance agreement. D. Reinsurance recover are considered income for the ceding company and must be recognized as such. Answer. C. Reinsurance recoverables represent the amount the ceding company expects to receive from the reinsurer for claims paid under the reinsurance agreement. Explanation. Reinsurance recoverables refer to the amounts a ceding company expects to recover from its reinsurer for claims that are covered under the reinsurance agreement. These amounts are classified as assets on the ceding company's balance sheet because they represent future payments. Reinsurer. These recoverables are recorded as part of the ceding company's receivables from the reinsurer and are only realized when the reinsurer pays its share of the claims. Question 6. Scenario-based. MS. Clark, the claims manager for a large insurer, is handling a claim under an excessive loss reinsurance agreement for a catastrophic event. The total losses from the event exceed the insurer's retention limit. According to the reinsurance agreement, the attachment point for the reinsurer is set at $2 million and the insurer's retention is $1 million. The total claim is $3.5 million. How much should the reinsurer pay under the agreement? A. The reinsurer will pay $2.5 million. B. The reinsurer will pay $1.5 million. C. The reinsurer will pay $1 million. D. The reinsurer will pay the full $3.5 million. Answer. B. The reinsurer will pay $1.5 million. Explanation. In excessive loss reinsurance, the reinsurer's payment is based on losses that exceed the attachment point. The insurer retains the first $1 million, its retention limit, and the reinsurer covers the losses above the attachment point of $2 million. Given the total claim of $3.5 million, the reinsurer's share of the loss is calculated as follows. Reinsurer's responsibility equals or loss. Attachment point equals $3.5 million. $2 million equals $1.5 million. Thus, the reinsurer pays $1.5 million, which is the portion of the claim that exceeds the retention limit. Question 7. Which of the following is a typical characteristic of a surplus share reinsurance agreement? A. The ceding company retains a fixed portion of each risk, and the reinsurer assumes a percentage of the risk above that amount. B. The reinsurer assumes a fixed percentage of both the premiums and risks for all policies within the portfolio. C. The ceding company transfers the entire risk to the reinsurer, and the reinsurer pays 100% of the premiums. D. The ceding company and reinsurer share the risk and premiums regardless of the size of the underlying policy. Answer. A. The ceding company retains a fixed portion of each risk, and the reinsurer assumes a percentage of the risk above that amount. Explanation. In surplus share reinsurance, the ceding company retains a specified portion of each individual policy's risk, e.g., a certain amount of coverage, such as $500,000, and the reinsurer assumes a percentage of the remaining risk above that retention. The reinsurer receives other premiums that correspond to the proportion of risk it assumes. For example, if the ceding company retains 50% of a risk, the reinsurer may take 50% of the remaining risk and premiums. Question 8. Which of the following is true regarding the role of a reinsurance broker? A. A reinsurance broker represents the reinsurer and is responsible for underwriting the reinsurance policies. B. A reinsurance broker works as an intermediary between the ceding company and the reinsurer, negotiating terms and facilitating the placement of reinsurance. C. A reinsurance broker only represents the ceding company and cannot engage with reinsurers. D. A reinsurance broker is responsible for the claims process and ensures that the reinsurer pays its share of losses. Answer. B. A reinsurance broker works as an intermediary between the ceding company and the reinsurer, negotiating terms and facilitating the placement of reinsurance. Explanation: reinsurance brokers act as intermediaries between ceding companies, primary insurers, and reinsurers. They facilitate the placement of reinsurance by helping to negotiate terms, secure the best pricing, and ensure that the appropriate coverage is in place. Brokers can provide valuable advice and expertise. They do not underwrite policies or handle claims directly. Their primary role is to connect buyers and sellers of reinsurance. Question 9. In the context of reinsurance pricing, which of the following factors is most likely to influence the cost of reinsurance premiums? A. The reinsurance treaty's profit-sharing arrangements. B. The historical loss experience of the ceding company and its portfolio. C. The number of policies included in the reinsurance agreement. D. The credit rating of the primary insurer. Answer: B. The historical loss experience of the ceding company and its portfolio. Explanation: the pricing of reinsurance premiums is primarily influenced by the historical loss experience of the ceding company and its portfolio of policies. If the ceding company has experienced significant losses in the past, the reinsurer may charge higher premiums to account for the increased risk. Other factors such as the reinsurance treaties, profit-sharing arrangements, and the insurer's credit rating may also impact pricing, but loss experience is one of the most direct and significant determinants in reinsurance pricing. Question 10. Which of the following best describes the purpose of a reinsurance treaty? A. A reinsurance treaty allows the reinsurer to select specific risks to assume based on individual underwriting decisions. B. A reinsurance treaty is an agreement between the ceding company and the reinsurer to automatically transfer all risks within a specified category or portfolio. C. A reinsurance treaty guarantees that the reinsurer will assume 100% of all claims from the ceding company. D. A reinsurance serves as an agreement for the ceding company to pay a fixed premium to the reinsurer for assuming future risks. Answer: B. A reinsurance treaty is an agreement between the ceding company and the reinsurer to automatically transfer all risks within a specified category or portfolio. Explanation: a reinsurance treaty is a broad, ongoing agreement between the ceding company and the reinsurer that specifies the terms under which the reinsurer will automatically assume a portion of the risks within a defined category or portfolio. Unlike reinsurance, where the reinsurer selects individual risks to accept, a treaty establishes a framework for continuous risk transfer without the need for individual negotiation each time a new risk is assumed. The agreement typically outlines the types of risks covered, retention limits, and the reinsurer's share of losses. Question 11. In a proportional reinsurance agreement, which of the following is typically true? A. The ceding company retains a fixed percentage of both premiums and losses, and the reinsurer takes on the remaining portion. B. The reinsurer is only responsible for covering losses above a predetermined attachment point, while the ceding company retains all premiums. C. The reinsurer assumes all premiums but only covers losses above a fixed threshold. D. The ceding company transfers all losses to the reinsurer but retains all premiums. Answer: A. The ceding company retains a fixed percentage of both premiums and losses, and the reinsurer takes on the remaining portion. Explanation: in a proportional reinsurance agreement, both the premiums and the risk are shared between the ceding company and the reinsurer based on a fixed percentage. This means that for every policy or loss covered by the reinsurance agreement, both the premiums and the claims are divided proportionally between the parties. This differs from non-proportional reinsurance, where the reinsurer only pays above a certain loss threshold. Question 12. Which of the following is not a feature of facultative reinsurance? A. It is typically purchased on a case-by-case basis for specific risks. B. The reinsurer has the option to accept or decline individual risks. C. It is a long-term agreement that automatically applies to all policies of the ceding company. D. It is often used when the ceding company faces risks beyond its retention capacity. Answer: C. It is a long-term agreement that automatically applies to all policies of the ceding company. Explanation: facultative reinsurance is purchased on a case-by-case basis and applies to specific risks that the ceding company wishes to cede to the reinsurer. The reinsurer has the option to accept or decline individual risks, and the arrangement does not automatically cover all policies. In contrast, treaty reinsurance covers a portfolio policies on an ongoing basis without requiring individual negotiations for each policy. Question 13. What is the main difference between quota share and surplus share reinsurance? A. In quota share, the reinsurer assumes a fixed percentage of both the premiums and losses for every policy, while in surplus share, the reinsurer assumes only the portion of risk above the ceding company's retention. B. In quota share, the reinsurer only assumes premium payments, while in surplus share, the reinsurer only covers losses. C. In surplus share, the reinsurer assumes the entire premium, while in quota share, the ceding company all premiums. D. There is no significant difference, so both are identical in structure. Answer A. In quota share, the reinsurer assumes a fixed percentage of both the premiums and losses for every policy, while in surplus share, the reinsurer assumes only the portion of risk above the ceding company's retention. Explanation: in quota share reinsurance, the reinsurer assumes fixed percentage of both premiums and claims for each policy, meaning the risk and premium are shared proportionally. In contrast, surplus share reinsurance is on structure where the ceding company retains portion of the risk, typically fixed amount per risk, and the reinsurer takes on the surplus risk above the ceding company's retention. Question 14. Which of the following factors most directly influences the cost of reinsurance premiums? A. The underwriting guidelines followed by the ceding company. B. The amount of capital available to the reinsurer. C. The loss experience of the ceding company's portfolio of risks. D. The administrative costs of the reinsurance broker. Answer: C. The loss experience of the ceding company's portfolio of risks. Explanation: the loss experience of the ceding company's portfolio is a major factor in determining the cost of reinsurance premiums. If company has had history of high claims or catastrophic losses, the reinsurer may increase the premium to reflect the higher risk associated with providing coverage. Other factors such as capital availability and administrative costs play a role, but are secondary compared to the underwriting risk. Question 15. In which of the following situations would excessive loss reinsurance most likely be used? A. When a ceding company wants to share a fixed percentage of both premiums and losses for every policy. B. When a ceding company wants to protect itself against a single large loss that exceeds its retention limit. C. When a ceding company wants to cede all of its risks to a reinsurer. D. When a ceding company wants to purchase reinsurance for every policy within its portfolio. Answer: B. When a ceding company wants to protect itself against a single large loss that exceeds its retention limit. Explanation: excessive loss reinsurance is used to protect against large unexpected losses. It covers the amount of a loss that exceeds the ceding company's retention limit, helping to prevent financial strain from catastrophic event. This type of reinsurance does not cover all losses, but is designed for specific large losses. Question 16. MS Jenkins is managing the reinsurance for a large insurance company and is reviewing a reinsurance treaty. The treaty specifies that the reinsurer will assume 50% of the losses above the insurer's retention of $1 million up to a maximum of $5 million. If the insurer faces a $7 million loss, how much will the reinsurer pay? A. $3 million. B. $4 million. C. $5 million. D. $6 million. Answer: B. $4 million. Explanation: in this excessive loss reinsurance arrangement, the insurer retains the first $1 million of the $7 million loss. The reinsurer is responsible for the losses above this retention point. The total loss is $7 million, and the reinsurer covers 50% of the $6 million above the retention limit, i.e., $7 million, $1 million. Therefore, the reinsurer's share is $3 million, and the total payment by the reinsurer is $4 million. Question 17. Which of the following is a characteristic of a reinsurance pool? A. The pool is typically composed of only one reinsurer who assumes all the risk for its members. B. Reinsurance pools allow multiple insurers to share the risk and premiums associated with large, high-risk policies. C. Reinsurance pools operate under facultative reinsurance agreements, selecting individual risks. D. Reinsurance pools are only used in treaty reinsurance agreements. Answer: B. Reinsurance pools allow multiple insurers to share the risk and premiums associated with large, high-risk policies. Explanation: a reinsurance pool is a group of insurers who collectively share the risks and premiums of large, high-risk policies. This pooling of resources allows each insurer to reduce its individual exposure while still participating in the coverage of large risks. Pools are used for specific large risks. Catastrophic events are typically more common in treaty reinsurance agreements. Question 18. Which of the following statements best describes the attachment point in non-proportional reinsurance? A is the amount at which the ceding company's reinsurance policy begins to cover losses. B, it refers to the point at which the reinsurer assumes all losses. C, it is the level of loss at which the ceding company's reinsurance policy stops covering claims. D, it determines the amount of reinsurance premiums that the reinsurer will charge for coverage. Answer A, it is the amount at which the ceding company's reinsurance policy begins to cover losses. Explanation. The attachment point in non-proportional reinsurance, such as excessive loss reinsurance, is the threshold at which the reinsurer becomes liable for covering losses. Any losses below the attachment point are retained by the ceding company, while the reinsurer covers losses that exceed this point. The attachment point helps to protect the ceding company from large, unexpected claims. Question 19. Which of the following is typically excluded from reinsurance coverage under most reinsurance agreements? A. Catastrophic losses caused by natural disasters. B. Losses arising from criminal acts, such as fraud or arson. C. Losses from normal business operations. D. Losses from regulatory fines and penalties. Answer. D. Losses from regulatory fines and penalties. Explanation. Most reinsurance agreements exclude coverage for regulatory fines, penalties, or sanctions because these are not typically seen as insurable losses. Reinsurers generally do not cover losses related to fines or penalties imposed by regulatory bodies, as these are considered to be part of the legal and financial risks of doing business. Question 20. What is the main advantage of using reinsurance in managing catastrophic risks? A. Reinsurance allows insurers to retain more risk, which can increase profits. B. Reinsurance helps insurers reduce capital requirements and stabilize their financial position. C. Reinsurance increases the insurer's exposure to high-frequency, low-severity losses. D. Reinsurance reduces the need for loss prevention efforts and risk management. Answer. B. Reinsurance helps insurers reduce capital requirements and stabilize their financial position. Explanation. Reinsurance helps insurers manage catastrophic risks by transferring a portion of their exposure to reinsurers. This reduces the capital required to cover large, unexpected losses and stabilizes the insurer's financial position. By sharing the risk with reinsurers, the insurer can better absorb large losses and maintain finance solvency. Question 21. Which of the following best describes the concept of retention in reinsurance? A. The amount of risk retained by the reinsurer under the reinsurance agreement. B. The amount of risk retained by the ceding company before the reinsurer becomes involved. C. The amount of loss that the reinsurer is liable for under a non-proportional agreement. D. The portion of the premium paid to the reinsurer for assuming risks. Answer. B. The amount of risk retained by the ceding company before the reinsurer becomes involved. Explanation. The ceding company retains a certain level of risk, the retention before the reinsurer becomes responsible for further losses. This is the amount of loss the ceding company must cover on its own before reinsurance applies. Question 22. In a treaty reinsurance agreement, the ceding company is required to automatically cede certain types of risks to the reinsurer. Which of the following is the primary benefit of this type of arrangement? A. It allows the ceding company to cede risks on a case-by-case basis, providing flexibility. B. It provides the reinsurer with the right to accept or reject individual policies. C. It allows the ceding company to have certainty of coverage for all risks covered under the treaty. D. It results in the reinsurer assuming a higher proportion of the premium compared to the losses. Answer. C. It allows the ceding company to have certainty of coverage for all risks covered under the treaty. Explanation. Treaty reinsurance agreements provide automatic coverage for all risks that fall within the scope of the treaty. The ceding company benefits from having certainty that all eligible risks will be reinsured without needing to negotiate each one individually. This is contrasted with facultative reinsurance, where individual risks are negotiated separately. Question 23. Which of the following best describes the concept of retrocession in reinsurance? A. The transfer of risk from a reinsurer to a secondary reinsurer. B. The process by which an insurer decides which risks to cede to reinsurers. C. The underwriting process by which a reinsurer evaluates the risks of the ceding company. D. The portion of the premiums that a reinsurer pays back to the ceding company in case of excess claims. Answer A. The transfer of risk from a reinsurer to a secondary reinsurer. Explanation. Retrocession is the process by which a reinsurer transfers some or all of the risks it has assumed from the ceding company to another reinsurer, known as the retrocessionaire. This is a common practice used by reinsurers to manage their own risk exposure, particularly when they have taken on large or high-risk portfolios. Question 24. What is the primary purpose of using loss corridors in excess of loss reinsurance agreements? A. To limit the reinsurer's liability for losses. B. To provide an additional layer of coverage that kicks in after a certain threshold of loss is reached. C. To reduce the premiums paid by the ceding company. D. To increase the ceding company's retention before reinsurance coverage starts. Answer B. To provide an additional layer of coverage that kicks in after a certain threshold of loss is reached. Explanation. Loss corridors are used in excess of loss reinsurance agreements to create a layer of coverage between the initial retention limit and the point where the reinsurer becomes fully responsible for losses. The corridor defines the amount of loss that must be absorbed by the ceding company before the reinsurer becomes liable for losses, providing buffer to both parties. Question 25. Which of the following is a common reason why a ceding company would choose to use a surplus share reinsurance agreement? A. To receive an exact match of the premiums for each ceded risk. B. To maintain greater control over the pricing of individual policies. C. To cover large losses that exceed the ceding company's retention. D. To share the risk of underwriting profits and losses with the reinsurer. Answer. C. To cover large losses that exceed the ceding company's retention. Explanation. Surplus share reinsurance is typically used when the ceding company faces risks that could result in large losses. In this arrangement, the ceding company retains a portion of each risk up to a specified amount, and the reinsurer assumes the surplus. The portion of risk exceeding the ceding company's retention. This type of reinsurance helps the ceding company manage high exposure risks. Question 26. Which of the following is an example of a situation in which a reinsurer might use stop-loss reinsurance? A. When a ceding company wants to transfer some of its premiums to the reinsurer. B. When the ceding company wants to protect against a significant increase in its overall claims experience. C. When the ceding company wants to assume 100% of the risk for large losses. D. When the reinsurer wants to provide coverage for specific individual risks. Answer. B. When the ceding company wants to protect against a significant increase in its overall claims experience. Explanation. Stop-loss reinsurance is a form of non-proportional reinsurance that helps the ceding company protect itself against an excessive increase in overall claims experience. Under this arrangement, the reinsurer covers losses once the ceding company's total claims exceed certain threshold, helping to stabilize the ceding company's financial position and reduce the risk of large-scale losses. Question 27. Which of the following is a characteristic of non-proportional reinsurance? A. The reinsurer assumes a fixed percentage of both premiums and claims for each risk. B. The ceding company retains a fixed percentage of both premiums and claims. C. The reinsurer only covers losses above a certain attachment point. D. The reinsurer shares both the premiums and claims equally with the ceding company. Answer. C. The reinsurer only covers losses above a certain attachment point. Explanation. Non-proportional reinsurance, such as excessive loss reinsurance, means that the reinsurer only becomes liable for losses that exceed a certain threshold known as the attachment point. The ceding company retains the risk up to that point, and the reinsurer covers any losses above it, typically with no sharing of premiums between the two parties. Question 28. In which situation would excessive loss reinsurance most likely be used? A. When a ceding company needs to protect itself from high-frequency, low-severity losses. B. When a ceding company wants to share a fixed percentage of both premiums and claims. C. When a ceding company needs protection against a small number of large losses. D. When a ceding company needs to transfer risk for all of its policies. Answer. C. When a ceding company needs protection against a small number of large losses. Explanation. Excessive loss reinsurance is used to protect the ceding company from catastrophic or unusually large losses that exceed a certain threshold. It is most effective in situations where the insurer is concerned about rare, high-severity events, such as natural disasters or large claims. Question 29. What is the role of an Adjusted in the context of reinsurance. A. To negotiate reinsurance treaties on behalf of the ceding company. B. To assess and evaluate claims and determine the amount payable under the reinsurance agreement. C. To process reinsurance premiums on behalf of the reinsurer. D. To set the terms and conditions of reinsurance contracts. Answer. B. To assess and evaluate claims and determine the amount payable under the reinsurance agreement. Explanation. An adjuster in reinsurance is responsible for assessing claims made under the reinsurance agreement, determining the appropriate payment and ensuring that the reinsurer's obligations are met. This includes investigating claims, verifying losses, and working with the ceding company to determine the payout under the terms of the reinsurance contract. Question 30. In a reinsurance context, the term capacity generally refers to which of the following: A. The reinsurer's ability to write new policies. B. The amount of risk reinsurer is able or willing to take on. C. The reinsurance premium that is paid to the ceding company. D. The number of reinsurers participating in given treaty. Answer. B. The amount of risk a reinsurer is able or willing to take on. Explanation. In reinsurance, capacity refers to the amount of risk that a reinsurer can or is willing to accept in a given period. This is influenced by the reinsurer's financial strength, underwriting guidelines, and market conditions. Reinsurer with higher capacity can take on larger amounts of risk or offer more coverage to ceding companies.